and the, and the cash flow that the property generates, which is a big factor for lenders to loan on it. So that's why it's very, very important to stay close to the market, listen to Fed, look at the information, ask the lenders for their outlook and what is the reason for their outlook that they have, and how does that differ from your own outlook, or do you even have enough information to form an? Oh, can everybody hear me okay?
Yeah, I was getting ready to check. I can hear you fine. I hear you fine.
Okay, somebody said no audio in the chat. So if somebody else, if people can hear me, can you post a quick message? Okay, so somebody posted they can hear. Okay, thank you. So so yeah, yeah, I'll leave at that. From an underwriting perspective is, think of it 5 to 7 year out where the market would be, and underwrite your exit based on that. And for the current environment, one of the big thing is, you get a deal under contract today, you're going to be locking the rate in 1 month, maybe 45 days, or you get a lock, but it extends. Sometimes these deals can last, 5-6 months for closing. So what is the interest rate environment is going to be at that time, and make sure, in your underwriting you have that built in to make sure, you don't get caught in a interest rate or a changing loan environment. Mike, you have anything else to add?
Not, I don't think so right now on that one, Sanjay. I'd like
Okay.
to talk maybe on some of these upcoming slides a little bit.
Yeah. Go ahead, let's move to the next slide.
So, how far you want to go here?
There, yeah, this is good. So, so those of you who attend our webinars regularly, this is a curve. It applies to multiple areas, ups and downs. That's just the nature of life and other things. So it applies to the markets, applies to the deal, applies to a new investor entering, and then, as they get experience and they go through it. So similar thing, we kind of put what our opinion is from a market year over year. 21, there was a lot of optimism. 20 coming out of COVID, the 22, there was still, we were at the peak, and then finally, as the interest rates start to go up, we're there. On that 2022 on the right, at that time, the way we were looking at the Fannie Freddie, the agency loans, had the smallest spread, and as you got on to the bridge and other shorter term loans, those had the biggest spread, but that means there was an opportunity to shop and get the better rates and get those. And a lot of those deals that were being done were giving better return on those bridge loans, because you can get an interest only, you can get a lower interest rate because interest rates were still small, and everybody was getting bridge or non-agency loans, right? And that led to great deals. And as we will go on the next slide, we'll see how it changes. But leverage was as high as possible at the 2022. And as you go down, the interest rate has gone up, the leverage goes down. And we think, are we at the bottom yet? Our perspective is we are not quite there. There is at least one more interest rate hike. In our WhatsApp group, we posted the message today. Fed's message today was, well, there's at least one more hike. They think it's flat after this year, and next year maybe couple decreases in the rate, but it all depends on the market condition. That's what Fed said. right? And Fed kind of changes their outlook as they get the data and do this. My personal outlook is, this interest rate is still here to stay next year. If we get any decreases, we'll be lucky, but in my opinion, unlikely to decrease, just because U.S. economy seems to be doing well, is projected to do well. So if economy does well, inflation is there. It's a balance. Which way it tips, yet to be seen.
Yeah, yeah.
Go ahead, Mike. Anything?
Trevor, yeah, as well. Trevor, if you got anything you want to share, jump in anytime. And I think you touched on it, besides the high, um, the amount of leverage, or, how much, people were getting, 85% loans, also was the fact of the, and floating rate is, not new, ARM and things like that's been adjustable rate mortgages, things like that have been around for a long time, but people really got pulled into that, doing some things with the floating rates there for a while, as well, that became kind of, a quick, look like a quick way to hold it get it floating for a minute, stabilize, and then get it changed over to a fixed debt. So that also happens quite a bit.
Yeah, and I think never in the history of ever, at least my history, have you ever seen such a rapid increase in a short period of time. I mean, if you think about how quickly they escalated it, and almost at the same speed they escalated it, they lent a much less loan to value. So in theory, for a lot of operators, it was a double impact. And for years, people were buying bridge debt with floating rates, not even almost thinking to buy a cap rate insurance because everything was going down, not up. And so many people got caught. So many people got caught. We've had a lot of series, and you can find them on our YouTube channel. I'll put it in there, about blood in the streets, but it's definitely coming that people, nobody foresaw this, and the effect of it is going to be dramatic. And you need to really make sure that whatever deals you're getting into now, that you make sure that the debt is the correct debt, and that it's been reasonably priced out and it works for the deal. Because a lot of the deals only work because of the low debt.
Yeah. Yeah. So I changed the slide forward, Trevor, since you started talking about the increasing point of interest. So to tie that in, Sanjay, back over to you.
Yeah, thank you. So that's where we were the 2022, and then as we go into the 23-24, we're quite there at the bottom, and the curve may not just curve up right away. There may be a flat line at the bottom, and then we curve up if the interest rates are where they are and they stay, and economy may continue to do well, which would lead to that interest rate. So but the good part of this, where we are, like, if I can lever up as much as I can with the highest interest rate, whatever the interest rate available, we are at the bottom. And if a deal works, right, then, if it cash flows and if it meets the DSCR, the lender's requirement, and, you can pay the expenses for the property and cover the loan, what do we care, right? Like, the deal cash flows, you pay the interest, it's just another business expense, and you go. So any deal that works at the bottom of this curve here, lever as much, high interest or not, get the high interest, that's fine, but make the deal work and make an offer based on that. And then in future, it stays flat at the bottom for 5 years, or it curves back up in 2 years. Either way, you're ready, you're prepared, right? And that's the key, right? Even though this looks the bottom, it says that it's depression and these things, but like from our perspective, from Massive side, what we think and what we're doing is this is the best time to be doing the deals. And yeah, instead of making, reviewing 100 deals, making, 30, 40 LOIs and getting one deal, we're probably going to look at like 1,000 deals, go out and put out 120, 140 LOIs, and then we may get one deal because a lot of sellers have to adjust their expectations, their prices, and all that have to work out. But from a buyer side, if it works, it's going to be one of the best deals that you're going to have and we're going to get, and that's going to roll out in the next few years. Mike, you have anything to add?
No, I'm good there. Thanks, sorry.
Okay. Good. No problem. Trevor?
Yeah, no, I'm good. And if anyone has any questions, feel free to pop them in the chat.
Sounds good.
Yeah, and as I saw, there is some discussion in the chat from Sam regarding the Action Opportunity Zone. What we are discussing right now being interest rates here for long, or wouldn't this bring more inventory, depressing the prices more? And then as also pressuring rental rates.
Yeah. So we could take the question, right?
Yeah.
Okay. Yeah. So just talking about that question there, right? Like, and so commercial is a little different, and residential behaves a little differently, and that's a big reason. From massive capital side, we say, well, diversify on the different asset classes in real estate itself. So on the single family side, even though the values, the appraisals, as it seems, goes down, right? What happened in 2007, 2008, and then 2011, real estate values were down, right? Aggregate summary for single family side were down. And while we do only multifamily, those single family have an impact on the economy, the market, the cash, the money people have in their pockets, right? So that has an impact overall. So we monitor that and look at that because that's a big asset class, single family. But on single family side, if the owners don't get the price, they just live in the house a little longer, not move as much as they were before. And the investors side, they just hold on to a little longer, right, until they get the price. So on the single family side, the volume decreases and the price of those volume decreases. So it seems like the prices go down. But if you look at a volume that at the peak, the volume may be on the single family side, does the valuations really go down? Until you have a transaction, the value doesn't really go down. You hold it longer. But it's different on the commercial side, because on residential side, most of the loans are 30-year fixed, right? Even the commercial loans on single families are minimum 10-year fixed. There are some products, short-term products, but majority are the long-term. But on the commercial side, these multifamily loans, even the agency ones, they are 5 to 7 year. Yes, there are options for 10-year fixed, but hardly anybody goes for those. So those are shorter term loans. And just from a terminology perspective, on the commercial side, there is the term when somebody says, well, the loan has a term of 5 year and amortization of 25 or 20 years. That means your payment is determined based on a loan principal amortized over 20 or 25 years. But loan is due in full in 5 year or 7 year, the term of your loan. And that's the case on these commercial loans. And similar thing on retail and others. There are no Fannie Freddie 30-year products for these other commercial, other than multifamily asset classes. And even Fannie Freddie, they don't have 30-year fixed loans. HUD has some products that are long-term fixed, but which they have changed some things looking at the market. But traditionally, HUD hasn't been an attractive option unless you want to hold an asset for 20, 30 years long. So on the commercial side, it's a little different. You know, you cannot just hold it and say, well, I'll just hold it longer, right? At 5-year mark, you can't just hold it for 3 more years. You have to refinance it, and you have to go through that. So, Mike, you're telling me about the time, so I'll move faster. Thank you. Yeah, so the risk associated with the cycles.
I was not, Sanjay. I was just trying to get to the next slide because I think it supports your discussion. So go ahead.
Okay. Yeah, thank you. And I just saw the time, we're a little short on time. So yeah, and you know, debt and loan, I could talk all day long, because big part of my success has been I've been able to source the loans from places that others may not be or couldn't be fine there. And we're working on a little ebook or a little book on just working on the debt, right? Because what do you say to the lenders? What do you talk? That type of stuff. So, but that's a side note. So, yeah, so risk perspective, that's there. As you get to the bottom, you know, you have that from a loan perspective, you have the risk. So 21-22 fixed debt. From a 23 perspective, existing deal, you know, if you can get through it, avoid the recession, you're good. But as you get into the market and look at it, you know, assets that support the higher interest rate, that's really the asset that are going to be sold, or the pricing is going to be coming lower. And of course, we continue to look at the triple net assets. So what Mike and Trevor were talking, the retail, those are there, and you can go with those, because some of the other risk factors are mitigated. And traditionally, for the retail, since the Fannie Freddie options are not there, it's the banks and the depositors using their money to lend, right? So there is a impact on the loans there, but it's not as big of impact as it from the others.
Okay.
So, oh yeah, sorry, I was talking about the question. So yes, the single family, the pricing, you know, market-wise, actual appraisals would be lower, but effectively, in my opinion, pricing doesn't come down. On the commercial side, yes, it will come down. It has come down. The values of the properties have dropped. And the rental rates. So rental rate is a very funny thing. The way the market is, independent of the debt and the debt expense, your taxes and insurance, based on the value, goes up. Your expenses go up because the labor rate is higher. So there is more pressure on these commercial properties from an expense perspective. Where is that going to come from? It's not coming from the debt. Debt is only getting more expensive. So it has to come from the higher rental rates. So one of like my personal opinion is rents have to go up drastically in next few years. Yet to be seen. The timing is always the critical part. Like, when will that go up? Well, that's the balance. We don't know when that tipping point and balance exactly will be reached, but in next 2 years, rental rates have to go up to balance out the equation on these underwriting. And as we're seeing, just today, one of the deal we were underwriting, there is a 40 million ask on that deal, and we underwrote, and we're like, well, max I can get to is 28 million, and that's to kind of cover my debt, you know, whatever the debt I will get, and that's what it is. And you know, we can squeeze a little bit, improve, be aggressive on a couple factors on underwriting, and you can't really be aggressive on the loan. You can shop, and you're going to get what you're going to in the market. But you do other factors, we could push it to maybe 30 million offer, but still there is a huge difference. So sellers are expecting around 40 million for that particular asset. And they're cash flowing nicely because they have a debt that works for them. But for a new buyer, the 40 million price with the new higher debt, it doesn't work because it doesn't cash flow enough. And so that seller is now going to look and say, well, can I hold it longer? what other options I have? Can I go renegotiate with the lender? And that's kind of the dynamic that's happening. But irrespective, I think rental rates have to go up quite a bit, another 20 to 30%, in my opinion, in next 2 years to balance out the equation. You know, we don't see the prices going down, labor rates and cost of material and those things. That may go down, but others, the only way to meet that is through higher rents.
And on the
Yeah.
loan to value, the one you're talking, someone was asking, what was the loan to value when you underwrote that one today?
So on that one, actually, it was a stable, relatively stabilized assets. And as I reduced the offer price, DSCR was very healthy. So I was underwriting that at a 70%, because on agency, if you can meet the 1.25, 1.3 DSCR, you will get the 75% LTV. Yeah. Thank you.
And then there's
Go
another,
ahead, Mike.
no, there's another question in the, no, I think it was a direct to me, so I'll come back to it. You want to look at a couple term sheets, Sanjay?
Yeah, let's go to term sheets. So we have a couple examples of the term sheets here. This one, you can see I'm the guarantor on this, but this is a term sheet for an asset we have under contract. We are shopping, and it's a smaller multifamily apartment. It's and going through a broker and talking through multiple lenders. Finally, we settle with this term sheet. So it's a full recourse loan. So guarantors will need to have enough balance sheet to match the principal amount of the loan. Purchasing the property, loan amount. So we are getting a 75% loan to value or loan to cost, which we think value would be higher. And there's an 18-month interest only. We are trying to negotiate that to 24 months, which is fully possible. Lenders will present, and you have to go ask. Without asking, you don't get if you don't ask. And then a 5-year fixed. So like I was saying earlier, most of these commercial loans are 5-year fixed, and it's a small bank on the East Coast side that, and they have deposits. They don't have money to use anywhere else, and that's where they want to use. And actually, it's a below 7% interest rate. So that is a very, very good interest rate from a non-agency loan perspective.
Yes.
Can you go back to the previous one still?
Yeah, sorry, Sanjay.
Yeah, no, thank you. And these loans still have a prepayment penalty. If you refi or you sell it, again, you can negotiate. You can always negotiate on these prepayment penalties. So some of the agency stuff is fixed. There is not a whole lot you can change. But when you're dealing with the bank, the credit union, other funds, there's a room to negotiate. From a covenant perspective, they're asking for deposits. And so that deposit actually is a very, very good, very big negotiation point where you say, well, I will bring the deposits, and it could be your rental income or security deposits or whatever you have. Based on that, banks will change give you better terms if you're bringing the deposits. So that's just a full recourse bank loan for a multifamily property.
Yep.
Next one, Mike.
Okay. And then Sanjay, if you see, I put one of the questions there in the chat.
Okay, let's go to the other term sheet and we'll go to the questions after that. Sound good?
Yep.
Yeah, okay. So this is actually a low term sheet for an office building in Houston. This is actually, we got denied by almost 12 lenders because offices are just not something lenders are willing to lend on. And this particular lender, they said no to office, but they came, visited the property, they met the team, the GP team for this particular project, and then they were comfortable comfortable with the loan. And they said, okay, given the team and the business plan of the team, we are okay, and we are okay to lend. And the key terms of this term sheet, it's a 65%. On the previous sheet we saw it was 75%. So that's that right there. The 10% difference in the LTV makes a huge difference on your underwriting. And your underwriting is very, very sensitive to the LTVs as long as your interest rate is lower, right? So as your LTV goes down on a very high interest rate loans, you will see your cash on cash go up. But if your interest rates are lower, high LTVs make your cash on cash go up. So this one is a 65%, and not only this is a 65% LTV, it's a 8.25. So it's a 6.8 to 8.25. So if you're underwriting a office asset, you have to put in the loan terms similar to this, right? And originally, when we underwrote this in underwriting, we was like, okay, if I can get a 60%, that's great, right? And then finally, this lender came and they're doing the 65%. Interest rate is higher. Maturity is still 5 years, so it will be 25. There is the 25-year amortization, but it's still due in 5 years. And we're trying to negotiate that a little bit longer. Always good to have a little extra room on that. And then how the proceeds will be used, what the collateral will be, and then the conditions. And you see how big that paragraph of conditions is here versus the covenants on the previous page. And this is another bank, and I believe they said they are going to do partial recourse. So this is not a full recourse, I believe. And they're going to do a partial recourse where as the deal goes, the recourse amount of the loan goes down based on certain conditions and criterias on the property. So which is always helpful, just in case anything goes south or anything happens. So that's a different term sheet. Kind of underwrite with that and go with. So those are the only two term sheets we have. Kind of shows the difference. We didn't get a chance to put some agency one, but agencies are quite frankly kind of similar from a terms that are used, but non-recourse. That's always the big thing.
And I did have a question outside that got sent direct to me. It doesn't happen too often, but if you have a loan with a bank and a bank fails, what actually happens to your property? What are the ramifications of that?
Yeah. So I used to work for the banks, Barclays, and then Capital One. So when a bank fails, what happens? All the loans that a bank does are assets, because those are the payments coming into a business called that bank, right? So Federal Reserve does the test. They visit the bank. They do everything. And when a bank is failing or close to failing, Federal Reserve knows, their auditors know, or the bank will communicate and they'll say, well, we don't have cash, or we're out of money, or whatever, or Federal Reserve will say, well, you don't have enough reserves. We're going to liquidate you as a bank. So what happens is typically Federal Reserve will try to arrange a buyer for the bank, and usually it'll be another bank, and Federal Reserve will go through and assess who is a good buyer. And quite honestly, that process can take anywhere from 1 day to a couple months, 3 months, 6 months even. The Silicon Valley Bank, I believe it took almost a month. A podcast I was listening to, one of the guys, he was a CEO for a bank previously, and Federal Reserve keeps those guys on a speed dial. So the auditors, right, when they say, oh crap, this bank is going to fail, They call these guys, they have lifetime careers on banking. They call them and say, hey, I need you to go for 3 months here, take over a bank, run this bank. That has failed. So it kind of partially runs under a Federal Reserve purview, depending on the size and impact. And then Federal Reserve goes through a process of selecting a buyer, and there's always a buyer. And they approve the buyer. Once the Federal Reserve approves the buyer, the new owner takes over those assets, and they bring the liabilities, which is the cash deposits, right? So it's a process. It technically, in an ideal world, for the consumer side, there shouldn't be any difference on loan payments or their cash deposits. Practically, how fast things unfold. Sometimes the cash is blocked for a day, 2 day, or whatever. Loan payments may go somewhere in an account and not applied to your loan or whatever. Or if you miss a payment, you may not get a reminder or those type of thing. But eventually somebody takes that asset and then they catch up. Another podcast I was listening to some case studies on single family loan. Somebody didn't make a payment for 2 years back in 2007, 2008. And then somebody bought that bank. Finally, Federal Reserve figured out. And then the new owner was going after, like, hey, you're behind for 2 years, we're going to foreclose. And they were trying to fight, like, not my fault. So do they ever get any principal reduction or not? Unlikely, in my opinion, but worth the fight. And that's kind of the process that happens and kind of rolls out. Great question.
And there was one question too, just talking about that term sheet goes back and forth, right? That's your negotiation, right? You ask the bank, they send you the term sheet. You say, well, how about, instead of 18 months, 24 months. And that's, you negotiate through the term sheet, correct?
Yeah. So the way the process looks like, we usually have our packet that we send to the lender for the deal. And as we send those packets, we may get a response and somebody says, well, no, that's not our area. That's not our focus. Some people say, well, we are very interested. Let's talk, right? So we will get on a call, talk to them. They'll give us the loan terms that they think they can get through the bank credit review and risk review committees. And during that conversation, we'll say, well, can you give me a little more interest-only period, but I'll give you this or that. So there's a little bit of a negotiation there on the phone. Based on that, the term sheet will come out. And once you see the term sheet, then there could be another round of negotiation and asking. And typically, interest rate is the interest rate. Hardly ever any negotiation with the bank on the interest rate itself. Term, that is a negotiable point. And, longer term, depending on how the yield curve is, there may be interest rate implication on that. The origination fee, oh yeah, that's all the money in the pocket for the bank, right? So that's fully negotiable. There is no Federal Reserve based interest rate, right? That the interest rate they're giving is based on the Federal Reserve underlying Fed rates, Fed fund. But on the origination fee, we've negotiated that from 2% to 2 points to half a point. So that those are negotiable. And again, you got to give something. They got to run a bank or the lender, and they got to put food in front of their family and the employees. So you got to give something. What can you give? You can give deposits. You can bring other business to them, or open a CD if you're going to have a balance. So there are banks can benefit from various things, and those are the negotiation points.
Lily, go ahead and unmute yourself and ask your question.
Yeah, thanks. And I also wanted to just check, Edwin, just put back in the chat, Edwin, if that answered your question or if you need further discussion. And then Lily, please go ahead.
Looks like she disappeared.
Where did she go?
Stage fright. There she is.
Oh, she is.
Sorry, my daughter was in the room and she started to cry, so I'm like, oh, gotta go. Okay, I'm not gonna waste so much time. Hello, my name is Lily. I'm very new with this webinar, so thank you, Trevor, for introducing me to this webinar. So I didn't, of course, I'm new, so I didn't get a lot, but I want to ask, since you're talking about lending, the lender and the bank, is there such thing as like certain bank will work with certain deal, like the bigger the bank will work with bigger deal, or the local bank will also can take on any kind of deal?
Yeah, so very good question. All right. Being outside, you would think every lender is a lender, right? They're loaning money on whatever. But lenders have risk profiles. So, they will focus on single family, multifamily, retail, whatever asset classes, and the area. And a lot of the time, the area a bank will focus on is driven by what the mandate or what is a business plan that the bank has given to Federal Reserve, right? And that can change on an annual basis. So there's an annual plan and the conversation with the Federal Reserve that happens. So based on the geographic area and the type of loan and asset is a focus for every bank, every lender that they have. Outside of that, the size, right? So absolutely. I mean, if there's a bank and they only got $1 million in deposits, there's no way they can do $100 million loan, right? So the size matters, and some of the size conversation can be driven by Federal Reserve also. So if a bank has 30 million in deposits, they can lend up to 300 million total on their books. And then the Federal Reserve will say, well, no one loan will be more than 10% of your total aggregate that you can lend. And the bank may on top of that say, well, Federal Reserve is saying 30 million, but we want to keep a max loan to 20 or 15 million to limit our risk to a one loan defaulting or something happening, right? So for that, planning happens. And that kind of goes back to what I was saying, right? Like we'll have a loan packet where we would say, hey, we have this asset, this is our underwriting, this is our cash flow, this is our business plan, and based on this business plan, here's the team, this is what we're looking to do. So you almost kind of have to sell a business to a bank, and based on that, banks will say, yeah, this fits our criteria, or this doesn't fit our criteria, and then the conversation starts. So very, very good question.
Excellent. Thanks, Sanjay. Hey,
Awesome. And I'm a bit cautious of time here because we're a little bit past the 7.
Trevor, can you hear me okay?
Oh, sorry. Yes.
No, it's okay. It's the same. I wanted to tell everyone as well. I put in the chat a link to the Massive Capital WhatsApp chat group. I can put it there again, but if you guys are interested to continue to connect in that manner with us, join our WhatsApp group. I also shared again, Edwin jumped off, but I also shared again the massive.capital/access. That also gives a great opportunity. It's more of a landing page, but it just has like the list of everything you can connect with us on, whether it's coaching, whether it's the investor portal, the She program with Jasmine and her team. So you can get, whether it's also submitting deals. So everything is there at a fingertip. So take a look at those two things. Join our WhatsApp group and be connected there. If you got more questions, it's easy to follow up. Last thing I want to share was Jasmine puts here, we will be in New York next week, on Monday, and we have an event there. So come join us, sign up. Jasmine put the link there if you're in New York or you're around there, or you're going to be traveling up there. Come join us for that. Shariah and Bo and Grant will all be there with Vlad and Megana, I think, as well. So thank you, Trevor. Go ahead, sir.
Awesome. So I was just being conscious of the time because we're 7:07 right now. So did we, and obviously you announced a couple of things. So my thing was anything to announce before we go to a free for all of any questions.
Gotcha. Sorry about that. But
yeah. I didn't know if you had.
That's really it, I think, you know, and let me share the screen one more time. If I can, go ahead and talk while I'm getting.
Yeah, we'll hang out here as we always do. So any questions, happy to answer questions. Did I miss a question from the chat that was there?
Oh, there's the thing for next week as well, Trevor.
Okay, good.
How to underwrite new development deals. New construction, how to underwrite new development deals next Wednesday. And QR code there to join us.
Awesome. So we do this every Wednesday. Invite your friends. Come and join. Oh, Al's got his hand up. Go ahead, sir. Should be able to unmute yourself. There you go.
Can everybody hear me?
Yes, sir.
Yeah.
Good, good. Hey, yeah, I had dropped a question in the chat. And it sounds like it's pretty obvious question, but I just wanted to kind of sanity check. Typically when you're getting rate quotes from the broker and you're looking at deals and you're getting a rate quote from the broker, and with the rates market, you know, the interest rates adjusting the way they're doing, typically what I've seen is that rate quote is typically lower, right, than what the current market rate is. So when you're doing your underwriting, is it better to use that broker's rate quote or just use the current interest rate that's going on right now to value the deals?
Sorry, so let me make sure I understand the question. So the question is, we're underwriting a deal, the current rate is the current rate, and then we get a quote from the broker. Do I use the current rate or whatever the broker quoted?
Correct. So I'll get a term sheet or quote sheet from the broker, and many times, sometimes that depending upon when that that number is out, that quote is out, it's sometimes it's lower than what's currently on the market. So when
Oh,
you're
I
doing
see.
the writing, which is better to actually use?
Yeah, I mean, I would use the latest quote from a lender if I have that available. And if that's not there, and if the loan quote I have is older, then you have to adjust for the current market. And if it's higher, you have to underwrite higher. And not only that, what I was saying, you know, if you're submitting an LOI like that office building and stuff, like you anticipate to close in take 6 months for closing. Well, guess what? We are anticipating one rate hike. So we are going to underwrite that in our underwriting that, or we will have at least one rate hike. So I'm going to put that in. And, you know, if I think there may be another one, then maybe put another rate hike. So those are the things you have to, and no, it's not an obvious question, by the way, Al. It's, you know, the deal hunting, it's a very fast moving. You got to move fast. You got to underwrite, make a decision, LOI. You have competition from others, right? In that rush, in that hurry, right? You got to have the right loan code. So a lot of people don't think about that. Like, oh, what do I use? Yeah, just put a number and move on and go. No. You got to spend time, and that's it's not always obvious. Thank you.
Very well, thank you.
Yeah, and I can imagine too, when there's lots of money out there, it's easier and you can do more with it. But as credit tightens up like it has, obviously it becomes more challenging, right? The world is just supply and demand on everything. And when there's less supply, it's tougher to get good loans. And when there's lots of supply, it's easier, you know. So like 3 years ago, people were getting crazy loans, like, you know, 80% loan to cost, not even loan to value, because there was tons of money out there. And that's actually why some of those deals are in trouble, where now you're getting, you know, 65, 70% loan to value. And, you know, so obviously the whole world is supply and demand, and lending is the same thing. Any other questions? And it doesn't have to be